The S&P 500, the index that tracks the 500 biggest U.S. companies, finished the week of May 15th up a tiny bit, just 0.21%. So the headline says Green Week, but under the surface, this was an ugly week. The average stock fell, small companies got hit hard, and the quality businesses we focus on, well-run companies with long records of growing profits, kept losing ground to a small group of giant tech names. I'm going to walk you through what really happened, slide by slide. No buzzwords, plain English. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here's the plan today. First, a quick recap of the market. Second, what's happening with the economy and the Federal Reserve. That's the U.S. central bank that sets interest rates. Third, a smart outside view from a publication called Compounding Quality. Fourth, our value-aligned portfolio, what we own and how it did this week. Picture two things at once. A rocket racing up, a crowd of people standing still, watching. That's this market right now. A handful of giant companies are blasting off. The other 490-some names are barely moving or going backwards. That gap matters more than the headline number you see on the news. Let's look at the numbers. The S&P 500, those 500 biggest U.S. companies, was up 0.21% for the week. The NASDAQ 100, which holds the 100 biggest tech-heavy names, was down 0.32%. The equal weight S&P 500, a version where every single company counts the same instead of the biggest ones counting more, was down 1.24%. And the Russell 2000, an index of 2,000 smaller American companies, fell 2.31%. Same week, four very different stories. The smaller and more average the company, the worse it did. Here is the gap in plain numbers. The S&P 500 finished the week up 0.21%. The equal weight version finished down 1.24%. The difference is about 1.5% in a single week. That is huge. It means a tiny handful of mega-cap names, companies like Microsoft, Apple, Nvidia, held up the headline number, while almost everything else dropped. The rally is concentrated. Concentrated rallies don't last forever. When they break, the average stock catches up. Year to date by sector, meaning since the start of the year, energy stocks lead, up 24.3%. Tech is right behind, at 20.6%. Materials, companies that produce things like steel, chemicals, paper, up 13.2%. At the bottom, financial companies down 6.6%. Healthcare down 7.2%. So you have a 30% gap between the best sector and the worst this year. That is not a normal year. That is a market where you have to be in the right neighborhoods. The five biggest winners in the S&P 500 this week: Palo Alto Networks and CrowdStrike, both cybersecurity companies; Unity, Nvidia, the AI chip giant; and Cardinal Health, a healthcare distributor. The five biggest losers: Boeing, the airplane maker; Home Depot, the home improvement chain; Dover, an industrial company; Salesforce, a big software company; and Amazon. The message: cybersecurity and AI ran hard. Anything tied to housing or to consumer spending lagged. Now let's talk about why the bond market freaked out this week. Inflation came in hot. The Consumer Price Index, the government's main measure of how fast prices are rising for shoppers, was up 3.8% compared to a year ago, the hottest reading in about 3 years. The Producer Price Index, what businesses pay for the things they sell, was up 6%, the biggest yearly jump since December of 2022. And retail sales, what shoppers actually bought, were up 4.9%. So people are still spending. They are just paying more for what they buy. The bond market reacted fast. When investors lend money to the U.S. government, they get paid back interest. That interest rate is called the yield. The 10-year Treasury yield, the rate on a 10-year loan to the government, climbed toward 4.6%. The 30-year yield, the rate on a 30-year loan, pushed above 5%. Higher yields mean borrowing gets more expensive for everyone, for homes, for cars, for businesses. The futures market, where traders bet on what the Federal Reserve will do next, now shows 0 rate cuts left for 2026. Goldman Sachs pushed its next cut forecast all the way to December 2026 or March 2027. JP Morgan went further. They said the next Fed move could be a hike, meaning rates go up, not down. One more thing. The Senate confirmed Kevin Warsh as the next chair of the Federal Reserve. His first meeting is in June. Markets will read every word he says for clues. Now I want to share a smart outside view. A publication called Trends Magazine just published their May economic update. Their case is long-term bullish, meaning they think US stocks have years more room to run. Let me walk you through why, because some of their evidence is hard to argue with. A secular bull market is a long stretch, usually a decade or two, where stocks generally go up. Trends magazine says the current secular bull started back in 2013. Stocks are up about 350% from there. The two previous secular bull markets ran 19 and 20 years. They gained 470% and 1,300%. Trend sees no real reason this one should end early. Inside this big trend, there are shorter rising stretches called cyclical bulls. The current cyclical bull started in late 2022. It is 3.5 years old. Once a cyclical bull crosses its third birthday, history says it usually runs another 8 years on average. Bank of America does a monthly survey of the world's biggest fund managers. 52% of them expect a soft landing. That is, when the economy slows down without going into a recession. 32% see no landing, meaning the economy just keeps rolling. Only 9% expect a hard landing. Trends magazine's biggest call is on technology. They point out that tech stocks in the S&P 500 trade at 23 times forward earnings. That phrase means investors are paying $23 today for every dollar these companies are expected to earn next year. The rest of the market trades at 21. In past bull markets, tech traded much higher than this. Two real-world numbers back it up. Global sales of semiconductors, the computer chips that power phones, cars, AI servers, basically everything modern, hit $88.8 billion in February alone, up 61.8% from a year before. TSMC, the Taiwan-based company that makes most of the world's advanced chips, reported revenue of $35.9 billion for the first 3 months of 2026. Their profits jumped 58%. And the 5 biggest cloud computing companies, Microsoft, Amazon, Alphabet, Meta, Oracle, are expected to spend $646 billion on equipment this year. About 70% of that money is going to chips, servers, and memory. Trends tracks 4 investor mood meters. All 4 are flashing positive, but not crazy. First, the American Association of Individual Investors. They survey regular investors every week. Their bull ratio crossed 49%, only the 12th time that has happened since 1987. Each prior time, the S&P 500 was up about 16% 1 year later. Second, the NAAIM index, a survey of professional money managers, sits near 95. That means they are almost fully invested. Third, the CNN Fear and Greed Index, a tracker that mixes 7 different market signals, reads 67, which CNN labels the greed zone. Fourth, the Investors Intelligence Reading, a survey of newsletter writers, has bounced back from near zero. So sentiment is positive, not the kind of euphoria you usually see right before a market top. Cautious optimism is the read. Now the wild card. The Iran conflict flared up again this week. Brent crude, the global benchmark price for oil, jumped more than 5%. It has been above $100 a barrel since the conflict came back. Most of the world's oil ships through a narrow waterway called the Strait of Hormuz. If that gets closed or threatened, oil prices spike. Gasoline in the US is now averaging $4.50 a gallon. There's a tech angle too. NVIDIA disclosed that its specially designed AI chips for the China market have not yet been approved for commercial sale there. That is a real overhang on the whole chip industry. The bottom line on the macro picture, the big picture economy, is what people are calling higher for longer. That phrase means interest rates stay higher for longer than people expected because oil keeps feeding inflation. And inflation keeps the Fed from cutting. Quick look ahead. Home Depot reports earnings Tuesday, May 19th. NVIDIA reports Wednesday, May 20th, the single biggest event of the week for anything AI related. AutoZone reports the following Tuesday. Notes from the last Fed meeting may come out. And every Iran headline matters. The bull case, the optimistic story, is softer inflation, Iran calming down, NVIDIA delivering a great earnings print, and the 10-year Treasury yield easing back toward 4.4%. In that world, the rally broadens out, and the quality stocks that have lagged catch up. The bear case, the pessimistic story, is sticky inflation, the 30-year yield punching above 5%, Iran getting worse, and Friday's sell-off turning into a multi-week drop. In that world, small companies and rate-sensitive names take the brunt. If this is useful, hit subscribe so you don't miss next week's review. We do this every Saturday. Now the Value-Aligned Portfolio, VAP for short. That is the model portfolio we run at VAP Wealth Advisors. This week, the VAP was down 2.32%. The S&P 500 with dividends included was up 0.17%. Year to date, the VAP is up 2.07%. The S&P is up 8.7%. Over the last 12 months, the VAP is up 26.18%. The S&P is up 27.3%. So this week, we underperformed by about 2.5%. Year to date, we lag by about 6.5%. The pain was concentrated in our semiconductor names, AMD, ASML, Taiwan Semi, and in our software and consumer discretionary holdings. We will look at every name in a moment. There is a publication I want you to know about called Compounding Quality. They focus on high-quality businesses for the long term. The same playbook we run. They just put out a market update. Their lead line, while the S&P 500 seems to keep going up, quality stocks are facing a very tough time. The chart on this slide shows what has happened since April 2025. Owning the highest quality companies and avoiding the lowest quality ones has been a straight line down, about a 12% loss over 13 months. That is the opposite of what quality usually does. And here is the bigger signal. Warren Buffett's company, Berkshire Hathaway, holds about $400 billion in cash on the sidelines. Since Greg Abel was named the next CEO, Berkshire has trailed the index by 40%. The only other time that happened was 1999, the year before the dot-com bubble burst. Look at how the most famous quality investors are doing this year. Terry Smith runs one of the biggest quality funds in the UK, is down 11.3%. Bill Ackman, the well-known hedge fund manager, down 15.4%. Chuck Akre, a legendary long-term compounder, down 17.2%. Dev Kantasaria, a younger quality investor with a strong track record, down 20.5%. Compounding Quality's own portfolio is down 14.5%. These are the best long-term investors in the world. They are all down sharply. That is not a sign they are wrong. That is a sign the market is paying for momentum right now, not for quality. Here is the most important slide in this entire report. Intrinsic value means what a business is actually worth, based on the cash it can produce over time. Compounding Quality measures this for every company in their portfolio. In 2025, the intrinsic value of their portfolio companies grew 8.6%. The stock prices fell 6.6%. The portfolio got about 15% cheaper, while the underlying businesses got better. In 2026 so far, intrinsic value is up about 8.3%. Stock prices are down 17.2%. The portfolio got another 25% cheaper. Combined across 2 years, the quality portfolio is 40.7% cheaper, even though the businesses are 17% more valuable. Gaps like that do not close slowly. When they close fast. Napoleon's quote at the bottom of this slide sums it up. A genius is a man who can do the average while everyone around him is losing his mind. Our top 5 winners this week. Diamondback Energy, ticker FANG, up 7.87%. They drill oil in West Texas. Low cost, very profitable when prices stay high. Eli Lilly, ticker LLY, up almost 6% on the week. They make the new weight loss drugs you have probably heard about, Zepbound and Mounjaro, plus a deep pipeline in Alzheimer's and cancer. Permian Resources, ticker PR, up 5.68%. Another West Texas oil producer and our best year-to-date stock at plus 48%. NVIDIA, up 4.7% on a fresh all-time high midweek. And ServiceNow, up 4.27%. ServiceNow runs the software that big companies use to manage their IT, and they just announced a brand new AI workforce platform built with Microsoft and NVIDIA. And the bottom 5, Interparfums, ticker IPAR, down 8.81%. They make prestige perfume, Jimmy Choo, Coach, Mont Blanc. AMD, ticker AMD, down 6.83% on the week, but still up 98% for the year. So this is profit-taking, not a problem. Roper Technologies, ROP, down 6.53%. They own a bundle of small, sticky software businesses. Accenture, ACN, down 6.43%, the world's biggest consulting firm. And Home Depot, down 6.28% ahead of earnings Tuesday. Notice the pattern. The stocks that got hit are software, consulting, and consumer-facing, exactly the names the bond market punishes when rates stay high. The businesses are doing fine. The prices are not. This is the move I want you to remember from today's video. We have owned Microsoft for more than 20 years. We bought more last week. Why? Because Bill Ackman, one of the most famous investors in the world, just opened a brand new Microsoft position. He runs about 7 or 8 names total in his fund. When Ackman opens a new position, it is not random, it is a signal. Microsoft now trades at 21 times forward earnings, meaning investors are paying $21 today for every dollar of profit Microsoft is expected to make next year. That is the same multiple as the average S&P 500 stock. Microsoft's own 5-year average is 28 to 32. So one of the strongest businesses on the planet is getting priced like an average one. Ackman's playbook is 3 steps. Step 1. Identify. Track the great compounders long before you act. Build your list. He did not discover Microsoft in February. He had the work done years before. Step 2. Wait. Let the short-term traders, the rapid-fire hedge funds, the index funds that have to rebalance every month, let them dump the stock on bad headlines. Let the price come to you. You earn the buying opportunity by waiting for it. Step 3. Execute. Pay a price that respects the next 10 years of growth. He did it at 21 times forward earnings on a business growing its Microsoft 365 software at 15% a year and its Azure cloud at 39%. We are doing the same. 2 reasons we are confident in Microsoft right now. First, Microsoft 365, that is Word, Excel, Outlook, Teams, has 450 million daily users, costs about $20 per user per month, and is deeply tied into how big companies run every day. Replacing it would be a nightmare for any IT department. Their Copilot AI tool inside does not have to be the best AI in the world. It just has to be good enough, so no IT director ever has to defend swapping vendors. Second, Azure, that is Microsoft's cloud computing service. Microsoft is spending $190 billion on it in 2026. About 2/3 of that money is for growth, not maintenance. More than 10,000 large companies are already running AI workloads on Azure. And Azure grew 39% last quarter after removing the effect of currency swings. Here is the hidden piece almost no one talks about. Microsoft owns about 27% of OpenAI, the maker of ChatGPT. That stake is worth roughly $200 billion, about 7% of Microsoft's total market value, and it produces 0 current earnings. So when you subtract that hidden value, the real price you are paying for Microsoft drops below the market average. 3 takeaways from this week. 1. Index numbers hide the truth. The S&P 500 was up 0.21%. The equal weight S&P was down 1.24%. A few megacaps held up the headline while the average stock fell. That gap is where opportunity lives for patient owners. 2. The big picture story is shifting. CPI at 3.8%, PPI at 6%, the 30-year Treasury yield above 5%. Fed rate cuts pushed to December 2026 or later. Higher for longer is the new base case for interest rates. 3. The gap between great businesses and the prices investors will pay for them has rarely been wider. Ackman buying Microsoft, compounding quality holding their portfolio, our VAP holding our names. Same playbook. Build the list, wait for the dislocation, pay a price that respects the next decade.